You're going to be getting a sneak peek at our latest MROI Index Report. If anyone saw the first one, we released this about 3 months or 4 months ago. Ultimately, if you don't know who Mutinex are, on any given day, if you were to come to our office, you'd see us refreshing market mix models for our customers, which we do on a monthly basis. And earlier this year, we said, let's take a step back and take a bird's eye view of actually what's happening across all of the customers that we work with. What are they doing? How's their activity changing over time? What decisions are they making? And how are those decisions playing back ultimately? So this is our latest report coming out. And what's really exciting is that this report is going to be continuing to grow in depth and breadth over time. So yeah, please feel free to play along at home and follow as we go. Now, if this was a book, it would be a bit excessive if this was a book, this report, but if it was, we'd probably give it a title like Welcome to the Great Flattening. As I say, this is the second report. The first report had a similar theme, and we probably would have just called it Welcome to the Flattening. The theme that we're seeing is this flattening, this tightening of budgets for advertisers. And that probably doesn't come as a big surprise to many of you in the room. We know that the economic conditions out there are really tough at the moment, and businesses are finding it really hard to find growth. And that is often causing constraints on marketers and their budgets. To give you a bit of background as to where this is all going to be coming from. Now, given this is MeasureUp, I've probably got a good audience who will appreciate when I say that the data here is actually the most exciting data that I've looked at in my career. And I've had the privilege to work at places like Kantar and Quantium, BSkyB, and Meta. What's really exciting about this data set is that we're not just looking at behaviors and what consumers are doing or what advertisers are spending on, etc. We're looking at decisions and the outcomes of those decisions. And that's something that can be so rare to get in a data set. Not just what people are doing, but the impact of what they're doing, of those decisions that they're making. And our data is covering over $2 billion of marketing spend in Australia across the likes of telcos, insurance, QSR, CPG, auto, etc. So we've got a really powerful data set to start understanding what's going on in the Australian market at the moment. So if we take that bird's eye view, what's actually happening at the moment to budgets in particular? Well, we're seeing that people are having to make some really tough trade-offs. Their budgets are being tightened. They're not getting increased budgets year on year, and so they're having to make some tough decisions about what to do with that budget. So let's start to play this out in some charts. Now, let me just talk you through this chart firstly. You got your time at the bottom. That dark line, let me take you, please focus on that to start with. What we're looking at here is that at the end of 2021, there was growth in budgets, very high growth, and this was actually artificially high because a lot of people had started to come back into the market after COVID, so very high growth in budgets. And then that started to decline as you would expect it would. But that decline in year-on-year budgets has continued until the point that you see towards the end of 2023, budgets are now flat. The good news is that budgets aren't going backwards and not seeing budget cuts just yet. We're just seeing at the moment that advertisers are struggling to grow their budgets. Now, obviously at an aggregate level, that can hide some of the detail. When we look at individual customers, we can see that they can be quite split. Some advertisers are managing to argue for higher budgets year on year. And it's about equal proportions, as you might imagine. Some who are able to argue for higher budgets and some which are having those budget cuts. Now let's start to paint some color into this chart. And if we start to have a look at those colored lines above and below, this is where we split budgets into what's being invested in more upper funnel activity and what's being invested in lower funnel activity, and how are those levels of investment changing over time. Now, at the end of this line, what you're seeing there is that we're seeing an increase in budgets for lower funnel activity. And that's coming at the cost of upper funnel activity. Again, for many of you, this probably isn't a surprise. Advertisers are feeling the pinch, and they're feeling that they have to start investing or increasing their investment in that lower funnel activity because their businesses are saying to them, I want to see growth. I can't increase your budget, but I still need you to help grow our business. And so they're looking for that lower funnel sales activation, demand harvesting activity, etc., to try and make sure that they can hit their targets in a given quarter, a given month, a given year, etc. In terms of what else we're hearing from our customers, we're hearing that they're having to get more tactical. They don't know how the economy is going to change over the next couple of months or the next 6 months, etc. And so that means that often they're leaning away from big strategic decisions and purchases of media for the long term and leaning more into digital media, which they can activate on a shorter time frame in order to be reactive to what they're seeing and what's happening and how they're tracking against their targets. We're also hearing that advertisers are having to make tough decisions about the flighting of their media, about whether they can afford to be always on or whether they're having to start to condense their media spend to specific times of the year where they feel they've got more tailwinds and they can get a better efficiency of their spend. All of these conversations come to that same kind of conclusion that advertisers feel that the conditions we're facing at the moment are more about the short term. Many advertisers have been actually quite optimistic about the longer term. They feel that things are going to change, things are going to get better. They feel that interest rates will come down. And unfortunately, personally, I feel that this is misguided. And I feel that actually we have to start believing that the tough conditions we're in right now are going to stay with us. And the advertisers that will have the best advantage are those that start to plan for longer term and longer term tough conditions going forwards. So lower funnel activity is increasing its share of spend. But we're seeing that that's starting to become really competitive. And we know that the dynamics in that type of activity can start to get really competitive. So let's have a look at actually how that plays out in terms of the ROI. So this line chart is saying what is the 6-month rolling ROI for last year versus this year. This year obviously going up to mid Q2. What we can see is that there was some improved performance partway through Q1 and into Q2, but now we're seeing again a flat ROI. So again, businesses often saying to their marketing teams, we need you to do more with less or with the same ultimately. And we're seeing that that's proving to be really tough. And you could be positive about this and you could say, well, you know what? It's really tough conditions out there. Well done for actually maintaining your return of investment, given that we know that disposable income is just only getting tighter for our consumers. Or you could be more negative and say, there's so many opportunities out there in media at the moment, so many ways to leverage your media spend and get a better return. Why aren't you able to achieve that? I'll leave up to you as to which camp you're in. The one objective thing I think we can say is that it's proving really hard for marketers to help grow their business at the moment, given the budgets that they're receiving. So let's start to go a bit deeper on this. We've talked about just at a higher level what we're seeing in terms of trends on spend. And at a high level, we're seeing that ROIs are looking flat year on year. This is now moving away to just a bit of a table view, just because I think there's so many stories to see in the channel choices being made by advertisers and how those are changing over the last couple of years. So what this table is showing you is over the course of 2022 to 2024, how share of spend across channels is changing and what that looks like for those individual years. So at the top, we see out-of-home, and again, no surprise because that had that bounced back after COVID, and we see a lot of advertisers returning to out-of-home. So that main bounce occurred from 2022 to 2023, but we're still seeing growth of out-of-home after that point. And I think with out-of-home, what's really interesting is it's starting to reimagine itself and starting to steal more from digital advertising because of the likes of programmatic out-of-home, which is allowing advertisers to start saying, I can now buy out-of-home programmatically, and I'm going to start moving spend from display or others into out-of-home. So we're seeing growth there. And then we're seeing search. And this is where we start to see where that lower funnel increase in investment is starting to go to. Search and affiliates showing strong growth. That growth in affiliates is actually proportionally extremely high, so very strong growth for affiliates. And again, when we talk to advertisers about some of the reasoning behind their channel selections outside of ROI performance, it's also because what they're seeing is the tough economic conditions are leading to consumers to having to change suppliers a lot of the time. Consumers looking for new NBN plans, new energy deals, looking for new mortgages, etc. So even though conditions are tough, there is a lot of movement in service type industries. And that's why a lot of advertisers are saying, I need to be ready to catch that. I need to be in that demand capture, those demand capture channels, and to make the most of those. And if you can be priced competitively, etc., then those affiliates and search activities can start to perform well. There's also other, and it can often be frustrating when you have a bucket that says other. But this is actually really interesting because other contains a lot of those exploratory smaller channels. And the story that we're seeing here is that there was an increase in the use of those exploratory channels, and that can include the likes of podcasts, etc. What we're seeing now is that there was an increase in use of those, but people are starting to shy away now from those exploratory channels and starting to go back to a lot of the core media channels that perhaps they feel safer within, which they have perhaps a longer history of known ways of executing across. So we'll see people draw back from exploratory activity and back to those core channels. Then we see radio and BVOD in growth, but at a fairly low level. BVOD in particular is not making up for that decrease in spend or share of spend on TV, which was seen down at the bottom, dropping 8 percentage points. And again, that probably isn't a surprise. There's a lot of talk in the industry about declining audiences, etc. So a strong decrease there. And then we're seeing fairly flat levels across video, print, display, social. So that's what we're seeing in terms of where people are starting to move and some of the reasons why they're trying to move more into that demand harvest type channels rather than demand generation. The challenge that they have, though, is how can they try and use those channels to actually grow the bottom line, not just sustain the bottom line. And this is really where advertisers need to find the right strategies to do so. So let's have a look at actually how those channels are playing out. What is the ROI of those channels against the levels of spend we saw against them just before? Let me talk you through this chart. There's a bit going on here. So in every batch, we're looking at the channels and the ROI of those channels across Q1 and 2, selecting just Q1 and 2 so that we can have a fair comparison against 2024. Now, some of the headlines that we see from here is that search and affiliates are performing really strongly from an ROI point of view. And again, this kind of plays back to the idea that there are a lot of changes in services that consumers are looking for at the moment, seeking out better value subscriptions or providers. So that's performing really well. For me, what's going to be really interesting is how does that continue to perform? So are we going to continue to see that consumer behavior? Or actually, if we are now entering this new, I hate to say it, that new normal of high interest rates, etc., are people now not going to be switching so much? So for advertisers, I think it's absolutely crucial that they really monitor that performance of search and affiliates. If we continue to see investment across the market continue to pile into those channels, then they could become the value of those channels could decrease substantially. So at the moment, performing really well, but tracking that going forwards is going to be absolutely crucial. Social has been seeing a great return in performance. We saw it have the strongest performance back in 2021 and start to decline over 2022 and 2023. Now, there's the hypotheses about did it start to struggle with the likes of signal loss, etc., and has the adoption of the likes of CAPI, Advantage Plus, started to help rebuild performance there. Alternatively, it could be about the types of assets that people are using on those channels. We're seeing more and more advertisers start to lean on influencer creatives, etc. And there's been some strong results coming out for that type of activity. So on the whole, we're starting to see social start to accelerate in its performance. BVOD and TV ROIs are unfortunately not showing such a good trend. We were seeing linear TV start to increase in ROI up until 2024, and then it's starting to fall back. BVOD, meanwhile, has continued to decline over that time period. So there's a lot to unpack within this, but for me, some of the key areas are that at the moment, that demand harvesting does seem to be paying back for customers, but that may not be continuing in the future, and that's why it's so critical to be tracking as we go. Meanwhile, there could be opportunities within the likes of video and social to be trying to move up that funnel and still be building the brand awareness, etc. So there's 3 key takeaways ultimately from this. Firstly, that lower funnel is hot and it's getting hotter. We're seeing the market move in that direction, and that's going to be creating a more competitive pricing dynamic to be keeping an eye on. Secondly, we believe that the opportunities for advertisers are by understanding how they can start to diverge from those market trends. If market is moving in one direction, but you're able to continue to explore in new directions, that's where you might find the better value for money. And that's where advertisers are moving away from. So this is where you need to be looking to buck that trend. How can you run experiments to say, actually, if we start to move from affiliates or search into some of these smaller but growing channels, let's say SVOD, which is in the news at the moment as there's lots of opportunity emerging in that space, there could be great value there for advertisers that are brave enough and have the budgets to start exploring in those directions. And thirdly, to a point I made earlier, I think advertisers ultimately need to stop waiting for conditions to change. I think it's easy to have some optimism. Humans are naturally quite optimistic, and we expect that things are going to get better. And I don't want to be too negative about this, but I think we just have to accept that conditions are going to remain tough for some time to come. And I think that rather than looking to remain tactical in our approaches to media, we need to start becoming more strategic and thinking longer term about how media plans should be rolling out over the next 12, 24 months, etc., in a way that is going to be balancing that short term and the long term. I'm sure everyone's seen research that talks about that risk of starting to focus too much on that short term. And whilst it may be paying back right now, that could be creating limitations for growth in the long term, and that's what advertisers need to be starting to think about, rather than thinking we'll be switching upper funnel back on when conditions improve. That was everything I wanted to take you through today. So let's move on to questions if we have any.
Right, people, $100 Hoyts Lux card for you if you come out with a cracker.
I don't know if it's a cracker, but I've got a question. I've always been curious about return on marketing investment, and I'm assuming it's sales, yes. In markets where the buying journey is a lot longer, let's say, than other markets. You mentioned you've got data that underpins some auto activity. How can you track the impact of advertising when, let's say, the car buying journey is on average 7 months?
Yeah, great question. So for auto in particular, we do look for indicators of purchasing, such as leads, inquiries, etc. And then the auto manufacturers provide us with the expected conversion rate based on what they've seen in the past. So revenue for auto is based off expected conversion rates of the likes of either inquiries or leads, or the data that they have that's relevant.
Hi, another question for me. So you've shared your report with MROI. We are seeing that channels like social, online video have great MROI. You make an excellent point around the short term versus long term. Looking at just the reports, marketers could be tempted to go, I'm going to maximize on these short-term tactics that have great ROI at the moment. What do you suggest marketers also look at to plan for the longer term?
Yeah, great point. Look, there's no hiding away from the fact that market mix models tend to be able to pick up the purchase signal over maybe 6, sometimes 10 weeks after that media has been in market. So they are more about that short-term impact. My recommendation to customers is that in order to try and maximize as much upper funnel activity as possible, they need to know what the return in the short term is of that upper funnel activity. So they're leaning on all that research that's been done in the past that says brand building is important. It's going to deliver long-term growth for you. But you can argue its role on your media plan by saying we can still achieve the targets that you set out for us. We can still reach our quarter target or annual target because we know how much we're going to get back from our TV, our out-of-home, our radio investments. So you can argue the role of above the line or brand building through an ROI perspective and proving or predicting you're going to hit your targets, rather than leaning wholly on the research that says we believe it's going to give us that long-term benefit. So you still have to quantify it, you still have to give it that dollar number to argue for its role on a media plan.
We have another question here from the back, but from Slido, there was one around, and I'm wondering if it's due to lockdown, the big burst in return on investment for radio back in 21.
Yeah, that's my hypothesis as well, that commuting starts to come back online, so there was that burst in investment there.
Hi, Steve from Publicis. Quick question. You mentioned demand harvesting and obviously demand gen. My question, though, is the correlation between the two, or the codependence of the two. Is there a way of evaluating the impact of the ROI you see on search, given its harvesting, versus what your throwaway comment was it may come back because there's less demand generation? Is there a way to measure using your data to understand the codependence between the two?
Not easily. Again, my recommendation on these is to be looking at changes in we have these saturation curves that say what is that level of optimal spend on the likes of search, etc. So what we can see is if that recommended level of spend on search is starting to increase or decrease over time. And that can start to indicate whether there is more opportunity for search or a lower ceiling for search, if that makes sense.
So just a follow-up question. If there's pressure, though, from our clients saying, okay, we want to all pile into search or whatever the stronger ROI is, what information can we use of yours, though, that would justify that we still need a certain percentage of spend on brand and that top of funnel activity?
I think when it comes to search, the data you can use from us is to say, can you invest further in search? What is that headroom on search? Actually, do we think you could be increasing investment by 5-10% or so? Or are you going to be then at diminishing levels of return? So the data should be saying, is there room to invest further? Or actually, are you going to be diminishing returns? Is there a higher marginal ROI on another channel? And actually, for that additional dollar that you've got, you're going to get a better return on another channel.
I'm quite enjoying this.
Just take a seat. Maybe on the panel. Got it. The question, though, more is around if your demand gen platforms, which are generally going to be at a lower ROI on paper because they're more expensive, if you don't invest in those channels and generate the incremental media-generated incremental sales volumes, that ultimately then your bottom of funnel harvesting, like search, starts to taper off. What metrics can we use to try and predicate that likely decline before it happens? And I won't ask any more questions.
Okay, these are great questions, and they're absolutely on theme. So I think there's two parts to it. Firstly, again, there is the tracking element. So at the moment, we are seeing the ROI of search and affiliates continue to hold, despite that decrease in brand spend. Now, Whether that's going to continue, or whether actually we're going to see that start to fall away because they've started to remove that upper funnel spend, is something that either advertisers are just going to say, I'm just going to wait and see. Oops, sorry. Or they can potentially look back at times where they've done it before. With any of an output of a market mix model, one of the opportunities is to look at what's happened in the past. And the opportunity exists to say, have we explored this before? If they've never tried it before, it's hard for the model to predict what's going to happen in the future. If they have started to lean harder into lower funnel before at the expense of upper funnel, and then seen lower funnel ROI start to diminish, then that gives them the evidence to say that's got an impact on the long term. If they haven't explored in that area, and as everyone in this room knows, exploration, experimentation is so key, then the market mix model is not going to know what that long-term impact looks like.
Excellent. Worth noting, a few years ago when we last saw Contraction, we did do some work with another member on marketers remaining brave and working on branding and awareness and all the rest of it. But for now, please give Will a massive round of applause.